From the morning reading, stocks bounced sharply off chart support. Reports of a compromise between the Germans and Greeks to prevent a default later this month appears to be contributing to a strong global stock rally. European stocks are up 2% on average. U.S. stocks are having a strong day of their own. The Dow Industrials bounced very sharply off the initial chart support below its May low. That's not far from its 200-day moving average. The Dow is trying to regain its 50-day moving average. The S&P 500 has already done that. In fact, let's go ahead and pull that chart up. The S&P has bounced off its early May low in an impressive fashion. A one-day gain isn't enough to turn its short-term indicators positive, but they are improving. The 14-day RSI line is close to moving above its 50 line. MACD lines are still negative, but the spread between the two lines is narrowing. The hourly bars show the S&P 500 bouncing off its May low more clearly. Hourly RSI lines have bounced from oversold territory, while hourly MACD lines have turned positive, which helps explain today's strong action. The falling trend line, however, shows where the SPX may meet resistance. Next, let's take a look at the NASDAQ. The NASDAQ and small caps remain leaders. The NASDAQ Composite Index rising sharply today after surviving a test of the 50-day average yesterday. The ability of the NASDAQ to hold that support line is also positive for the market's short-term trend. So this is strong action in small cap stocks. The Russell rising above a new 6-week high. It too is trading above its 50-day average. The ability of these two leading indexes to hold firm has helped limit downside damage in large cap indices. And then finally, Wednesday didn't quite count as a breadth thrust, but it was close. Volume flowing into positive stocks accounted for 84% of total volume. When it accounted for 80% or more, the S&P 500 had been at a one-month low during a bull market. It led to higher prices over the next month 78% of the time since 1962, 46 occurrences. Over the past 20 years, the win rate was 87%. The S&P was higher 20 of 23 occurrences, averaging plus 2.2%. The S&P lost more than minus 3% at its worst point 3 times, but gained more than 3% at its best point 14 times, suggesting a positively skewed risk-reward ratio. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:53 a.m. Central Time, and I'm recording this in preparation for the market day of June the 11th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see what happened in our overnight action. Fairly quiet in the U.S. broad market indices. You have 3 of the 4 that would essentially be called scratch at the time of this cut. The Russell was a little weaker and was down about 0.4%. You have crude oil down 1.35% for the biggest mover of the 8 futures markets that we follow. Euro was down about 0.5%. Bonds scratch, and then gold down about 0.63%. In terms of overseas action, you have China up slightly at about 0.3%, Hong Kong more so, up 0.83%, Japan on a very hot fire, 1.68% up, Germany is up about 0.75%, and the United Kingdom up about 0.33%. So Europe and Japan in particular doing well in the overnight section, though not seemingly having any impact on the U.S. market thus far. On our macroeconomic reports for today, we have core retail sales, the weekly unemployment, and a 30-year bond auction, which is a yellow flag report, but as we've been talking about in recent days, given the interest rate sensitivities, that could be a tell as to where things are going, what kind of demand there are for bonds. On Friday, we had PPI, and this is before the market opens, and then during market hours, the University of Michigan Consumer Sentiment Report. So we've got several things that could move the market between today and tomorrow, so a little bit hotter than it was on Monday or Tuesday in terms of macroeconomic reports. In terms of our current volatility, note that look at this 5-day ATR versus a 10-day ATR increasing, and certainly we have seen an uptick here of late, but it's still relatively low. Short-term VIX down to a 13.32. You have implied IV percentiles 29, 23, 31, all in the bottom third of their range for the year. We did put in standard deviation moves on all 4 broad market indexes yesterday, so that was significant. Though in perspective, we've only had 2 standard deviation or greater moves put in by the S&P in the last 10 trading days. That's about half of normal. So we seem to get these little 1-day or sometimes 2-day bursts of energy, and then the market goes quiet again for a number of days. Seems to be the current trend on these things. Wouldn't be surprised if, given the size of the candle yesterday and of the action, and let's go back to the S&P here. Obviously we don't normally crash up, but also put in perspective, we're just right back into the trading range again. The other thing I would point out here is that so often, as has been the case in recent weeks and months, we get to where we tickle the bottom, and then you turn around 1 or 2 days later and you're 80% of the way back to the top of the range. Look right here. So big, ugly down candle, and yet where are you? 1, 2, 3 days later, you're about 3/4 the way back to the top of the range. 2 ugly days here, this one even undercut, and then where are you? 2 days later, 95% back to the top of the range. We hit actually a number of down days to get down to this bottom, so this was a little unusual in that we didn't just exactly crash down, but we actually just kind of had weakness over a course of about a week or so. Doji, well, maybe you could call that a spinning top there, but then we follow, and 1 day and we're back, we'll call it about 70% back to the top of the range. So these down moves have been met with often pretty aggressive bullish moves, and if you're extremely nimble, obviously there's opportunities to trade when you feel like it's catching the falling knife, but trade the bottom of the range and to be rewarded very quickly. But you got to take profits quickly as well. So got to be very aware of where the top and bottoms of these ranges are and the opportunities to trade within those. If you're that kind of trader, if you're a position or core portfolio trader, then you might use these opportunities to time your covered calls or to sell puts, and kind of go back and forth in a trading range around that. But in terms of just buy and hold, I have to say, for you folks who are buy and hold, it is a very difficult world, and likely to be a difficult world for some time to come. Let's see here. Let's go on to our regular daily report. In terms of the primary trend, our intermediate term phase opinion is phase 3, still higher highs, higher lows. IBD status, confirmed uptrend. GMI index is still a 4 out of 6, but there are some bugs in the water. Intermediate term market posture is very bearish, even after yesterday's action. S&P's at 34. Dow's at 20.9, NASDAQ is a 69.3, though the Russell did flip to first term bullish at a 71.9. So definitely flies in the ointment there, though if we get another positive day today, these may start to flip over to first day bullish on some of these lines. Hedge warning status remains a 0 plus, and this is actually the longest. I think we're around 18 days now, 18 trading days, the longest period of time in which we have held on to a hedge warning status of a 0 plus for 2015. Earlier this year, the first 3 times we were at this level, they all classically failed within just a few trading sessions and went back to higher risk levels. So this risk level has had more staying power, but no more follow through than any of the others. Back to the chart again, we haven't actually made anything. If you had entered any time in the last few months, you probably are pretty much scratched from wherever you entered the position on a core portfolio type position. So it has been certainly a position that is going to require a certain amount of patience. In terms of other warnings, volatility base is all pretty clean. We still have that VIX daily squeeze. We still have a relatively high distribution day count. In terms of not being at a warning level, it's at 4 and 4. If it goes to 5, that will trip us up into a warning status. In terms of highs and lows, I mean, for such a big candle yesterday, we didn't even go over 300 new highs. So not as impressive as it might seem, in terms of the number of stocks that were up. Now, we did have that headline at the beginning talking about breadth thrust, and certainly the volume was flowing into positive stocks and to a very high percentage, but it just doesn't feel quite as bullish as that candle would seem to make you think it is. But we'll see where this follows through, and if indeed we go back to the top of the range and roll over, or if we actually follow through in a significant way and have a breakout occur, that would be real confirmation of bullishness. In terms of risk aversion indicators, 2 of the 5 are still flagging as risk off. Our special opinions, option income strategies, no change here, and this perhaps has been the most reliable strategy in recent weeks and months, and being able to produce a desirable outcome and profit. Covered call strategy, still cautiously bullish, 3-to-2 distribution between in the money and out of the money. Put selling, much the same as the option income strategies. It certainly is acceptable, but you've got to be pretty nimble, and given the chance for a breakdown in this market, you'll have to always kind of keep that in mind. You define your risk, use credit put spreads, scale into positions, or certainly look to scale out of those positions if you find that you're near the top of that particular stock's range, or for the broad market. In terms of sector specific, it's pretty much a Christmas tree. We certainly look a lot better than we did, before today, where almost everything I think was on the short and intermediate term was red. So quite a bit better, but these are just one day away from red again. So very, very choppy market. It has been hard to do much with that kind of market posture analysis. In terms of percent change, obviously very good day all the way across. Utilities were the least, but they were still up nearly 0.5%, where the best were up 1.59% and 1.43% for information technology and financials. So that should take care of us for today. As always, if you found us through the YouTube channel, we appreciate you liking us. If you found us through Twitter, we appreciate you retweeting us. And certainly share with your trader community what you have found here if you find it of value. If you do find something that you'd like to give us feedback on, the email address is support@falconglobaltraders.com, and we certainly welcome that feedback. Web address here for additional information and how we actually apply these principles and concepts to our daily trading. Performance matters. We're quite transparent. It's very easy to understand what the model trades are doing and when and where they're doing it. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. And we'll see you back here tomorrow morning before the market opens with the market preview from Falcon Global.